Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're diving into FirstSun Capital Bancorp, that's ticker FSUN, and unpacking everything from their big Q4 2025 call.
So, FirstSun drops their earnings, and what happens? The market loved it. The stock shot up over 3% on call day, which is basically Wall Street giving a big thumbs up to the numbers and what they heard from management.
Okay, here's how we're going to tackle this. We'll start with the Q4 numbers, then dig into what's behind that beat. After that, we'll cover what management is saying and guiding for, listen in on the analyst questions, and then, of course, finish up with our take on the next call.
All right, first things first, the Q4 snapshot. And really, the headline here is pretty simple. A clean beat on both revenue and earnings.
On the earnings side, they posted adjusted EPS of 95 cents. Now, the street was looking for 86 cents, so, that's not just a small beat, that's a pretty significant one. That's the kind of thing that gets attention.
And it wasn't just the bottom line. Revenue also came in hot at over $111 million. The consensus was closer to $108 million, so they cleared that hurdle pretty easily, showing real strength on the top line too.
But here's what really makes this impressive. It's not just about beating a quarterly estimate. We're talking about an 11.5% jump in revenue compared to this time last year. That tells you there's some real momentum here, not just a one-off good quarter.
Okay, so how did they pull it off? Let's get behind those headline numbers and look at the engine room, the core banking fundamentals that drove this performance.
And wow, this table really tells the story. Take a look at that net interest margin, or NIM. It came in at 4.18%. That is a super healthy number for a bank. And get this, management pointed out it's the 13th quarter in a row they've kept it over 4%. You pair that with solid returns on assets and equity, and you've got yourself a very profitable machine.
Of course, profitability is one thing, but what about risk? Well, the balance sheet looks pretty solid too. Credit quality is holding up, net charge-offs are low at just 30 basis points, and their capital cushion, that CET1 ratio, is comfortably over 10%. Now, management did admit that their loan book can be a bit lumpy, but right now, things look really stable.
Okay, so let's shift gears to what management was actually saying on the call. The whole vibe was confidence and forward momentum. They weren't just taking a victory lap, they were all about execution and what's next.
Yeah, the CEO Neil Arnold really set the tone. He said, "We are pleased with our strong operating results in the fourth quarter. This quarter was highlighted by strong revenue growth and the growth in our net interest margin to a very strong 4.18. I mean, the message couldn't be clearer. Our plan is working, and it's working well."
And here's where it gets really interesting. They didn't just talk about the past. They gave a full-throated guide for 2026. They're telling the market to expect mid-single-digit growth in their core interest income. But look at non-interest revenue, low double digits to low teens. That's aggressive. And they plan to do all this while keeping a lid on expenses. It's a pretty confident outlook. Now, the big elephant in the room, of course, is the upcoming merger with First Foundation. And management made it crystal clear. This is their #1 strategic focus. They see this deal as a total game changer, especially for bringing in more deposits and expanding their treasury management business.
So naturally, when it was time for Q&A, the analysts jumped on the two biggest questions on everyone's mind. Can they keep up this incredible margin? And what does the future really look like with this merger?
The first thing they really dug into was deposits. I mean, it's a knife fight out there for deposits right now. So the question was basically, hey, that net interest margin is great, but how in the world are you going to protect it?
And to their credit, management didn't back down. They were straight up, yeah, it's super competitive. But they made it clear they're not playing the high-rate CD game and chasing hot money. Their whole strategy is built around deep customer relationships. Think operating accounts and money markets. So while they do think costs might tick up a bit, they're still guiding for that all-important net interest margin to stay relatively stable.
Okay, so the next big topic was, of course, the merger. Analysts wanted to know how this First Foundation deal is really going to change things, both on the cost side and for future growth.
And their answer was really telling. They're not just looking at this as a way to cut costs. They see it as a massive growth engine. For one, they think they can poach some great banking teams in Texas because of all the M&A chaos there. But the real prize? Southern California. They believe they can take First Foundation's huge portfolio of multifamily clients and sell them treasury services, bringing in tons of cheap deposits. That's a huge opportunity.
Okay, so let's put this all together. What does this mean for the next quarter, and what's our official take on FSUN? This is the next call.
Really, the whole story for the next year boils down to one word:
Execution. The catalyst is huge. If they nail this First Foundation merger and deliver on the synergies, this stock could really fly. But the risks are the flip side of that coin. If credit quality slips, if their funding costs balloon, or if they just plain mess up the integration, they could get left in the dust by their competitors. And check this out, because this context is so important. For all the good news this quarter, the stock has actually been a laggard over the past year. It's underperformed other regional banks and the S&P 500. So the big question is whether this quarter is the start of a major turnaround. They've definitely got some ground to make up.
So, with all that said, our rating on FirstSun Capital Bancorp is outperform. Why? Well, it comes down to three things. Fantastic execution this quarter, a clear and believable outlook for next year, and a massive company-specific catalyst in the First Foundation deal that could really unlock value. So that brings us to our trade idea for the next call. We think the play here is a pair trade. The whole idea is that FSUN is going to outperform its peers because of this merger. So you go long FSUN. But to protect yourself from the whole banking sector moving up or down, you simultaneously go short the regional banking ETF, KRE. The goal here is to isolate FSUN's performance and capture that alpha from their execution no matter what the broader market does.
And as always, this is not financial advice.